All right. Good morning. Good afternoon, everyone. This is James Bogart, Managing Principal of Bogart Wealth. I'm going to give it a few minutes to upload attendees. Looks like it's a more popular one today. Zoom's obviously been very successful for doing these types of events. We've got over 100 people joining us today, I think. Still loading up. All right, looks like it started stabilizing. Again, my name's James Bogart. I'm Managing Principal of Bogart Wealth. Before I get going on the presentation, I do have the question and answer box open as well as the chat box. I will do my best as I'm presenting to answer questions as they come in. If I miss anything, I'll definitely recap towards the end to talk about just overall strategy and current positioning. So Bogart Wealth is a registered investment advisory firm. We are specializing in financial planning, tax optimization, tax preparation, as well as investment management. There are 16 people on our team now. We've actually had a couple additions as of late. We have 3 offices, one in McLean, Virginia, one in Houston, Texas, and one in the Woodlands, Texas. Our mission is to help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. A lot of you have heard me say it before, but I can't emphasize it enough. Your kids and your parents can be some of the largest variables in anyone's financial plan. A lot of the strategy work that we're doing is not only to help you and your household, but also the longevity of your relationship as well. And I do think it's important to give your children access to certified financial planners. Very commonly, while I say, what would you do differently now that you know what you know, but back when you're in your 20s or early 30s? And that's when we can have some of the most meaningful impact on someone's financial plan. So today is actually part of a bigger webinar series that we're doing now. We've actually initially started with our retirement cash flow optimization plan, and it was 8 topics that we've been doing live for the last several years. And just given COVID-19, we've pivoted to doing them now virtually. But we've also added some additional topics with more timely data, for example, the Secure Act or the CARES Act as those have passed. And we're going to continue to be as timely as possible with new data. But the kind of staple presentations that we do one on the retirement planning timeline. We do one on retirement income planning, one on Social Security and Social Security strategies, one on tax planning, tax law changes, which is the one we're going to be doing today, one on estate planning strategies, one on net unrealized depreciation and post-retirement income strategies, one on long-term care and long-term care insurance, and then one on Roths versus traditional 401ks and IRAs. There's obviously overlap within some of the presentations we're doing as we're trying to make some key and critical points. We are recording all of these presentations, so if you happen to miss any one of them, feel free to send us a note. We're going to be doing actually a new website here in the next probably week or two, where we're going to be hosting all of our events and actually having them available for people to watch at their convenience. All right, so before I jump into today, we are obviously not necessarily tax advisors. We have to throw the disclaimers in here. We're very familiar with tax law, and we have tax specialists now on our team that are part of what we do. But specifically, we are not making investment recommendations or tax recommendations with the presentation today. All right, so with regards to the agenda, I really want to start off with the Tax Cuts and Jobs Act of 2017, because that did have a very material influence on the infrastructure. I'm going to spend a lot of time talking about what didn't change, what did change, and then I'm going to get into some real specific strategies to look at, whether it's using backdoor Roth contributions, looking at lifetime Roth conversion analysis, talking about the impact that net unrealized depreciation can have, as well as some capital gains and loss harvesting strategies, as well as also modeling out utilizing 0% long-term capital gain strategies and the material influence that can have on someone's long-term plan. All right, so a lot of this was established based on the 2018 tax reform. The official name for it is the Tax Reform HR 1, which was signed into law on December 22nd, 2017, also known as the Tax Cuts and Jobs Act. The Joint Committee of Taxation is estimating that it's going to cost about $1.456 trillion over 10 years. Now, approximately $1 trillion of that is coming from business tax cuts, such as reducing corporate tax rates from 35% down to 21%. Now, today, I'm going to spend a very significant amount of time talking about individual tax strategies. We do have a whole series that we talk about for business owners and some of the business changes that happened and some of the strategies we should look at employing. The vast majority of our customer base is mom and pop. So individual impact is really what we're caring about the most today, and that's what I'm going to spend the most time on. So we start with what hasn't changed. They did not change IRA contribution limits. They did not change rules regarding rollovers from retirement accounts. They didn't change the rules related to net unrealized appreciation. They also didn't change cost basis rules. They didn't change up rules associated with stepped up basis. And then lastly, they didn't change FICA and Medicare tax. So let's dive into this a little bit. So it's important to understand the difference between a traditional IRA as well as a Roth IRA. Now, a traditional IRA is where you put money in on a before tax basis. It grows completely tax deferred, and when you take the money out, it's ordinary income. Now, you can still do a contribution to an IRA account no matter what your income level is. Now, there's two categories within IRAs, what's considered non-deductible as well as deductible. I'm going to talk about deductible first. So in order to be able to take a deduction on an IRA contribution, there's two categories of households. Those that are what are called covered by a plan, and those that are covered, and then those that have one spouse who's covered by a plan. So if you're actively employed and you're covered by a 401k plan, or your employer offers a retirement plan to you, if you're single and you make between $65,000 and $75,000, if you're below 65, you can fully deduct it. It starts to phase out at 65,000, and once you reach 75,000 of income, you can no longer take a deduction. If you're married, the phase out starts at 104 and is completely phased out at 124,000 of income. Now, the second category of households is those that are covered by a plan. So those that are covered by a plan means that the husband or wife is working, they have a 401k plan, and let's say that the other spouse is not working. They don't have a retirement plan available to them. The phase out starts at a higher level. It's 196,000 is where it starts to phase out, and at 206, it completely phased out. So if you make over 206,000 married, you do not have the ability to take a deduction on an IRA contribution. And if you're over any of these income thresholds, you can fall into this category, which is traditional non-deductible contributions. There is absolutely no income limit for those that are over these income thresholds. You can still do a contribution, but you wouldn't be able to take a deduction. So for those that are under the age of 50, it's $6,000. For over 50, you get to do an additional $1,000 of catch-up contribution, so it's $7,000 total. Now, I bring up this whole non-deductible section because this does tie directly over into backdoor Roths, and I'll talk about that a little bit more in a minute. All right, so we compare this to Roth IRAs. Now, a Roth IRA is where you put money in tax-free, on an after-tax basis. It grows completely tax-free, and as long as the account's been in existence for 5 years and you're over the age of 59 and a half, all of the principal as well as the gain comes out completely tax-free. Now, you'll probably imagine Roth IRAs are our absolute favorite place to be accumulating wealth. The challenge ultimately is getting money into Roth IRAs. So there's only two ways of getting money into Roth IRAs. The first is doing contributions. The second is with conversions. So with contributions, they actually phase out as well based upon how much money you're making. So if you're single, they start to phase out at 124,000, and they completely phase out at 139,000. If you're married, it's 196,000, completely phased out at 206. So if you're married and you make over 206,000, unfortunately, you cannot do Roth contributions. However, the second way of getting money into Roth is what are called conversions. So with a Roth conversion, this is where you are making the decision to take money from an IRA account and convert it over to a Roth IRA. So you're going to pay taxes now in order to be able to move it over into a Roth. And then at that point in time, the Roth, it's in the Roth bucket, it's now growing completely tax-free. And once you reach the age of 59 and a half, you'll be able to take the money out completely tax-free as well. All right, so the reason I bring all of this up, and if you remember, I talked about these non-deductible IRA contributions, is because one of the strategies we talk about is backdoor Roths. Now, what this is saying is that you can actually do an IRA contribution, a traditional IRA contribution, if you're over the threshold, and then immediately convert it over to a Roth and making it completely tax-free. Now, here's how you do it. Now, one caveat to this is you cannot have a traditional IRA account in order for this to work and be completely tax-free. So while you're still actively working, if you happen to be in these high income thresholds and you don't have an IRA, or let's say maybe a spouse doesn't, well, this is a great way of getting money growing tax-free. But you go ahead and you put the money into a traditional IRA, you do not take a deduction. So it's that non-deductible traditional IRA contribution category. And if we completely convert it over, then that money is now converted over tax-free, it's in the Roth, and it's growing tax-free forever. I had a quick question come in. So if I'm single making $200,000, I cannot contribute to a Roth. That's correct. So if you're single and your income's at 200, unfortunately, you're over the threshold. You can't do a contribution, but you can actually look at doing conversions. So with conversions, if you have IRA accounts, this backdoor strategy doesn't make a lot of sense. But if you do not have IRAs, this makes a ton of sense and something that you should consider doing while you're continuing to work. All right. So now we're going to talk a little bit about retirement plan contribution limits. Now, these also did not change. They've indexed up over the last couple of years, but they haven't changed the ability to do these. So 401ks, 403bs, Roth 401ks, you're able to put $19,500 into those if you're under the age of 50. If you're over 50, you get to do an additional $6,500 of catch-up contributions. And so all of this money is capped out at a total of $57,000 of contributions if you're under 50, $63,500 if you're over 50. So just to use a real quick example on this, let's say you're over 50. So we've already established you can put $26,000 in, whether it be to the traditional or the Roth portion. So that's money you put in, so $26,000. Let's say that your employer contribution is $14,000. So that's the amount that they're matching for you. So that brings your total combined amount to $40,000. What this is saying is, again, if you're over 50, you could do an additional $23,500 of after-tax contributions into a retirement plan and still be below the threshold. So the reason that we bring that up is because it actually does still make sense if you can save more to get some money over into the after-tax amount as well. You know, a joke that a lot of you will hear me say whenever I do these presentations is the financial planner and us will have you work until you're 80, you die at 81, the plan's going to work great. We're also going to have you save every dollar that you ever make and leave nothing less to live on. Ultimately, it's a joke, but there's a lot of truth to that. The longer you work, the better your plan's going to be. But also at the same time, too, the more you save, the better your plan's going to be. What we're trying to help with is what is the most optimal place to be saving and accumulating wealth. And looking at doing those after-tax contributions does make a lot of sense as well. All right. Sale of primary residence. They did not take any changes here. So you can still exclude $250,000 of gain if you're single, $500 if you're married, tax-free. It must be your primary residence of 2 of the last 5 years. There's one exclusion to this, which is if you have moved into an assisted living facility, it can be 1 of the last 5 years if you've moved into assisted living. So for mom or dad, for example, if they've moved into an assisted living facility and they still own the house, but there's a big gain there, might want to be mindful of that as you're looking to selling it. 1 second, I had a quick question come in. So maybe so this may be a question for a one-on-one, but what type of vehicle would you specifically suggest the Roth conversion be invested in? Some type of mutual fund or really individual circumstances specific? So what I'd say to that is I don't want to specifically recommend a particular stock or strategy, but it is all dependent upon any individual's risk profile. Now, what I would say is Roth money, because it's growing tax-free, that typically is the last place that I would recommend somebody drawing from for cash flow purposes. And so it typically does lead to that being where I would recommend something that's a little bit more growth oriented in nature because it has a longer investment time horizon. And in some instances where we've been accumulating wealth in Roth accounts, that might be money that ultimately is getting transitioned over to your children. So it might even be appropriate for a particular portion of your investment strategy to have some of it potentially invested at their risk profile, again, because it's more long-term in nature. And I'll talk about transition of wealth here in a few minutes as well. All right, so sale of primary residence, they didn't change anything here. You could still get $250,000 or $500,000 of gain tax-free if you sold it. Cost basis rules, they didn't change these either. You can select specific tax laws when you're selling assets in brokerage accounts, non-qualified accounts, but it must be identified within the 2-day settlement period. The custodian can't change this. So this is something that if you're getting very specific on harvesting losses, and we'll talk about that as a strategy in a minute, harvesting losses or gains, we want to be very specific on what share lots that we're targeting for those transactions. FICA tax, so this is Social Security tax. They have not changed this either. Both the employer and employee portion is at 6.2% on the first $137,700 of income in 2020. Medicare tax also did not change as well. For individuals who make a single taxpayers that are make under 200,000, it's 1.45%. If you're married and you make under 250, it's 1.45%. But if you make over 250, you get to have this extra 0.9% surcharge tax, and it's 200 for single taxpayers, extra 0.9 on any dollar over that. That didn't change. That's been in existence for a couple of years now. The Obamacare tax. So this is net investment income or excess modified adjusted income tax. So if you're single making over 200,000, you get to pay an additional 3.8% on dividend income as well as long-term capital gains income. Married, filing jointly, 250,000 in combined income gets that extra 3.8%. All right, so that's what hasn't changed. Let's now talk about what has changed as relation to the Tax Reforms Act, and then we'll get into strategies. So we do know that the marginal tax structure itself did change. On average, decreased about 3%. So our new tax rates go from 10% to 12% to 22% to 24 to 32 to 35 to 37. That's same for single as well as for joint. Ultimately, the income thresholds changed a little bit. Now, one thing that I want to mention, and this applies to all of the Tax Reforms Act for individual taxpayers, is all of this is set to sunset on December 31st, 2025. And what that means is that on December 31st, 2025, everything with no legislative reform, everything is going to revert back to what it was. So the marginal tax rates are, in their present state, going to go back to what they were, which are all about 3% higher than where they are today. Now, the other thing that did change was the estates and trust tax rates. They go from 10% to 24%, 35% to 37%. Now, one thing that might throw people off is when you start looking at these income thresholds. So if you make from $0 to $2,600 for an estate or irrevocable trust, that's at 10%. From $2,601 up to $9,450, 24%. $9,451 up to $12,950, 35%. $12,950 and above is all at 37%. So the reason I'm bringing this up is irrevocable trusts are specifically what happens either when you establish an irrevocable trust or when a revocable trust transitions to an irrevocable trust upon the passing of the grantors, the people who establish the trust. So most of our clients set up revocable trusts while they're alive. Now, when they die, ultimately that converts over to what's called an irrevocable status. A lot of people can kind of get sucked into this tax trap for not appropriately planning for this or having the appropriate investment vehicles within an irrevocable trust, specifically ones that are generating a lot of income. So one thing that's important to talk about is trusts and estates. They're not tax efficient vehicles. They're never designed to be that way. Typically, an irrevocable trust is done more for control, whether it's an irresponsible child or beneficiary, might be because you're worried about the no good son-in-law. Whatever the reason is for the trust, it's typically done more for control mechanisms. We want to make sure that we're putting all of the appropriate provisions in related to your holistic estate plan. But one thing that we got to be mindful of is trusts are not tax efficient. They're control. And a lot of people get thrown off with that. But important to know. The other thing is when we talk about kiddie tax. Now, kiddie tax laws did get changed in 2018, and actually they got reformed again by the Secure Act at the end of 2019. And so I'm going to gloss over this part because this is what they were, and I'll talk about what they became. So kiddie tax, it actually applies to any child under the age of 19 or 24 if they're a full-time student. And what it's doing is it assumes taxable income equal to the top tax income range. So what they did, by the way, just taking a quick step back with the 2018 tax reform bill with kiddie tax, is they made the tax rates the exact same as what estates and trusts were. They realized they had made a mistake here, and they came back and they reformed it. So under the new calculation, and this is essentially very similar to what it was pre-2018, what they do is they look at the child's net earned income plus the child's net unearned income, and then they apply the child's standard deduction, and that's going to create what's called the child's taxable income. So for 2020, a dependent child's standard deduction is the greater of $1,100 or the sum of $350 plus the child's earned income, if the child can be claimed as a dependent. So this might make more sense if we show an example. With this example, so if a dependent child had no earned income and unearned income, let's just say dividends and interest were $5,000, and their parents' taxable income was $170,000. This is how it's going to get calculated. So they're going to take the unearned income of 0 plus the $5,000. They're going to back out the standard deduction of $1,100, and that's going to give us $3,900 for taxable income. So then what's going to happen is we're going to take the $5,000 of unearned income minus the $2,200 of the kiddie tax imputed exemption, which equals $2,800. This is the net unearned income amount. So the $2,800 is going to be taxed. So under the Tax Reform Act, the first $2,600 is taxed at 10%. The remaining $200 is taxed at 24%. So ultimately, all they did was they revised down and they increased these imputed tax exemptions, making it so that the kiddie tax wasn't as dramatic of an impact. But it is a change, and if you've got children who you're either gifting assets to or grandpa or grandma are gifting assets to, just something to be mindful of because this calculation is real and it does happen. All right, long-term capital gains rates, these did change as well, specifically talking about the Obamacare surcharge tax, but mostly what changed was the bracket as to where they apply. So what I'm going to focus on is this percentage, including the 3.8% Obamacare surcharge. But long-term capital gains rates go from 0% to 15% to 18.8 to 23.8. So what happens is if you're married, for example, under $250,000 of income, you're at 15% or less. If you go from $250,001 all the way up to $496,600, you're at 18.8. And anything over $496,601 of income, you get to pay 23.8% on long-term capital gains taxes as well as on dividends. Now, for single, it follows a similar threshold. 200,000, 441,000 jumps up to 23.8%. One of the things that this does introduce, though, is some level of planning opportunity. Let's say, for example, you're working and you might have a big taxable event. Might be a non-qualified lump sum. It might be a sale of business, something that's creating a more expensive tax year. And ultimately, if we don't need to sell something and we have the ability to push until the next tax year, then we should look at where we're harvesting gains. And if we can kick it into a lower tax year because we still think that the company that we're invested in is okay enough to get to the next year, we might want to consider it. On the flip side, one thing I didn't spend enough time on yet is the fact that if you make in the 12% bracket or below, long-term capital gains rates are actually 0%. That also creates some planning opportunity. And part of it is a lot of people say, hey, there's no way I could live on $80,000 married. Well, remember, what we're talking about here is taxable incomes. This is after deductions. And if you had, let's just say, for example, you need $150,000 a year to live on. Well, let's say it's all sitting in a checking account. If you're going to use the $12,500 a month as part of your paycheck in order to be able to live on, well, we haven't created a taxable event by using that money from the checking account, right? All we've had is dividend and interest income. we have the ability, especially in retirement when you don't have earned income, to bring your taxable income down in those years and really strategically look at some of these tax strategies, which I'm going to spend a lot of time on at the end of this. But one of the opportunities is looking at harvesting 0% capital gains rates. Be strategic in terms of how we sell investments over an extended period of time and potentially use that as part of the overall tax strategy. You know, ultimately, with all of these strategies, what we're trying to do is find ways to reduce tax obligations, obviously keeping everything legal and above board, but reduce tax obligations and keep as much money as we possibly can in your pockets. We do think that there's just as much of a meaningful impact on tax strategy as there is on investment strategy. All right, a couple other things that changed, and then I'm going to start transitioning to strategies. But Medicare premiums, these did change, all of them indexed up. So, for example, married, if you make under $174,000, your monthly Part B premium is a $144.60. It goes to $202.40, $289.20, $376, $462.70, and then if you're making over $750,000 and on Medicare, your premium is going to be $491.60 a month. So just something to plan for and keep in mind. All right, deductions got changed dramatically, and a lot of you are aware of these, but the standard deduction did increase. This was probably the most notable change they made with the Tax Reform Act, which was they took the standard deduction for single individuals from $6,350 up to $12,000 a year, excuse me. For married, they took you from $12,700 up to $24,000. And if you're over the age of 65, you get an additional $1,300 of deductions. Now, these have been indexing up for the last couple of years. So for 2020, single is $12,400, married is $24,800. The additional $1,300 has not indexed up though. So if you're over 65, you're just getting the extra $1,300. Now, personal exemptions. This was $4,050 per person. Under the Tax Reforms Act, it unfortunately is now zero. So for families that had a large number of dependents, unfortunately, this is really impacting them the most because those personal exemptions are now gone. Talk about some other areas where they kind of made up for it, but ultimately that is a negative one, especially for high income households. Itemized deductions with regards to mortgage interest. Now, what they did do here was they said, in order to be able to deduct interest off of a home mortgage, you're capped at $750,000 of mortgage debt. And if you happen to be fortunate enough to have multiple homes, that's a combined balance of mortgage debt. So let's just say you've got 500 on the primary and 500 on the second on your vacation home. Well, you're still going to get capped on $750 for new mortgages as of the end of December 31, 2017. They did give us a little bit of an exclusion here. If you had those balances prior to December 31, 2017, it's still at that $1 million threshold. So in the example I used a moment ago, if these were homes that you had previously, you're fine. But if they're new homes that you're buying now, unfortunately, we're still capped at $750. Home equity lines of credit, HELOCs, are no longer deductible just to be able to use the money for anything. There is one caveat to that. You can use them for home improvement expenses and still take a deduction. It's kind of cumbersome. You're going to need to include proof that you used it for home improvements, but it is something you can still use to be able to take a deduction on. Margin interest. Now, margin interest is when you would borrow against your investment portfolio, you can borrow securities against it. You can deduct margin interest. It is limited based upon the net taxable investment income. So you need to have dividend income or investment income in order to offset the margin interest, but that's still something that's now available as well. All right. This is the one that without a doubt has been the most painful for especially a lot of our households that are in high state property tax states, but they did cap state and local tax deductions. So in 2017 and prior, there was no cap on this. 2018 and beyond, they've capped these at $10,000. So if you live in an area that has high state and local sales, real estate, property taxes, we're capped out at 10 grand. And this is not set to index with inflation. One quick caveat on this, the most recent stimulus program that they've discussed is talking about for 2020 alleviating that cap. Ultimately, it's trying to increase the amount of tax benefit to households, but that has not passed yet. But that's one that's kind of right on the forefront that they're talking about pushing that one through. All right. Another thing that did get changed was they changed the ability to do charitable deductions. So in 2017 and prior, you were able to do cash and stock donations up to 50% of your adjusted gross income. In 2018 and beyond, you can do 60% of adjusted gross income as cash, 30% as stock. Now, for 2020, this is only for 2020, the CARES Act did make a change which allows you to do up to 100% of your AGI for charitable deductions. Again, only for 2020, but if you're more charitably inclined, something that you're able to do. Another thing that they changed was charitable deductions from retirement accounts. So if one of the things that we talk to a lot of our clients with retirement accounts about is how to manage their required minimum distributions. Excuse me. But prior to 2017, you were not able to take deductions on a year-by-year basis from retirement accounts to satisfy the required amount that you had to take out of retirement accounts. Now, there have been some changes here, and they've even changed since they made this change. But ultimately, you do have the ability, once you've attained the age of 70 and a half, to take up to $100,000 annually from traditional IRAs and send it directly to charities. You actually can do it for $100,000 for both husband and wife. It doesn't matter whose account it comes from, but $200,000 a household can go straight out of a retirement account to a charity. Now, once you've reached the age of 72, which is when required minimum distributions start from this point forward, once you've reached the age of 72, you can actually use that to satisfy part of your required minimum distributions going forward. Now, one thing to comment on too, also part of the CARES Act in 2020, they did forgive or relieve the ability or requirement to take out required minimum distributions this year. So anyone who's already over the age of 70 and a half and beyond, they're no longer required for this year only to take out required minimum distributions. We've been talking to our clients about how to handle that and the appropriateness there. But if you're charitably inclined and RMDs in the future are going to be an issue for you, you absolutely have the ability to use money, gift it to charity, and satisfy those required minimum distributions. Now, these aren't like normal distributions out of retirement accounts. These are actually having to be what are called qualified distributions. They have to go directly to a 501c3 or a donor advised fund. Now, for anybody who doesn't know what a donor advised fund is a type of charitable structure where we can actually send money over to, whether it's funds from an IRA once you've reached 70 and a half, you can donate cash, or more importantly, you can donate highly appreciated securities into a donor advised fund. You're going to get the benefit of the tax deduction in the year that you move the money into the donor advised fund, but ultimately have the ability to spread the funds out to a charity of your choice over an extended period of time. So as I mentioned, you can contribute both cash as well as appreciated securities. You get the tax benefit now. You do have the ability to choose the investment strategy within this. It does provide a high level of tax diversification. So if we're trying to really be strategic in terms of what our taxable income is in any given year, this is a great way of doing it. And especially if you're already doing charitable gifting or tithing, these are great ways of doing it. One thing that I always say is anybody who has highly appreciated positions of any stock whatsoever, they shouldn't be writing charities checks anymore. They should donate the shares into a donor advised fund and then use the donor advised fund to have the proceeds go to the charity of their choice. The reason this makes sense is because if you donate the shares that have big gains in them, you get to completely avoid selling the stock, realizing the gain. You're going to get the benefit of the donation as of the price that it's donated at. So let's just say, for example, we look at Amazon stock up over $2,400 a share. You might have bought it at $300. You get the ability to donate the shares into the donor advised fund at the $2,400 a share. You skip out on having to pay long-term capital gains on all of that appreciation. That's a great strategy. Now, the only requirement with these donor advised funds is you have to distribute 5% of the outstanding balance each year. So if you put $10,000 in as an example, you're required to distribute $500 of it. So just 5% of the balance. Now, you can do all of it, right? And it allows you to be very strategic in terms of the timing of when you make the donation in the donor advised fund, but then also be flexible in terms of when you give it to the charity. So these are great tools, great ways to helping with some of the charitable gifting, but also spreading things out over more on your timeline. The question was, can Bogart manage a donor advised fund? How long can the fund stay there before donating to the charity? So we do donor advised funds, absolutely. Now, donor advised funds fall into what we call core accounts. We don't charge a management overlay for them, but it's something that we find is a courtesy for our existing clients. It makes a ton of sense to do them. Now, the funds can stay in there in perpetuity, and you can designate a successor owner or person to designate of how the funds would be distributed. Now, like I said, you're just required to distribute 5% per year of whatever the balance is. But we've got clients that potentially, let's say, for example, they have a big tax year. Might be you're retiring this year, you've got a non-qualified pension program or selling a business, whatever the big taxable event is. And that ultimately is going to drive you into a real high tax bracket. Well, why not in that year look at where we have highly appreciated positions? And if you're any level of charitably inclined, that is a great way of moving some money out, pre-fund a few years worth of your charitable gifting or your tithing to bring the taxable income down, especially if you're going to be in the 37% tax bracket. Why not? That's a great way of doing it, and ultimately can also help with some diversification strategies if you've got a concentrated position. All right, a couple other things that have changed. Itemized deductions. So miscellaneous deductions subject to the 2% adjusted gross income limit will be eliminated for 2018 to 2025. Some examples of this are tax preparation fees, unreimbursed employment expenses, investment fees, casualty and theft losses, relocation expenses, dues to professional societies. All of those are eliminated, unfortunately. Sorry, I had a question come in. How are the charitable trusts different than donor advised funds? Can you give some examples? Can I contribute to a donor advised fund each year, then withdraw the entire balance for a gift? So just going back to these donor advised funds. So the question really is, should you set up your own trust or should you consider using a donor advised fund? The answer is it really depends on your situation and your estate plan. But what I have found is charitable trusts are relatively expensive to administer relative to something like a donor advised fund where it's significantly lower in terms of administrative cost with providing ultimately the same level of flexibility. When we were talking to a client about trying to establish a donor advised fund because they were going to do a more meaningful gift versus a charitable trust, it really took about $250,000 of donations into that charitable trust to justify the administrative expenses associated with having that charitable trust, which has to file its own tax return each year. There's a lot of additional pieces to having that. Whereas doing a donor advised fund, it dramatically simplifies all of that. I will tell you that I went the route of donor advised funds because I just love the simplicity of it. Now, the big negative I would say with donor advised funds is if you're donating under $250,000, and again, I say big negative, it depends on how charitably inclined you are, but if you're donating under $250,000, the security that you put into it has to be invested in one of the pre-done investment pools. Once you donate over $250,000, you get the ultimate flexibility to choose the investment strategy, and you can choose the investments that go into it. But if the objective is to diversify away from a position, and if you're donating into it, you don't really care at the end of the day, at least I haven't, because I'm just trying to get money to the charity, but at the same time to not have to realize the long-term capital gains implications ourselves. I'm happy to do any level of consulting you'd like to talk about with looking at charitable funds versus donor advised funds and pros and cons of all of them. Feel free to reach out to me. All right. Couple things that also got eliminated. Itemized deductions. So these had phase out limitations on them. Those have been eliminated. Obviously, they've pretty much eliminated all itemized deductions. So those are gone at least until 2025. But they did start phasing out at certain income levels. Another dramatic change they made with Roth IRA conversions, they did eliminate what are called recharacterizations to Roth IRAs. So what a recharacterization is when somebody does a Roth conversion and then tries to reverse it. This is very different than a contribution that you did and then all of a sudden you made more money and you needed to take out the excess. But what was happening is people were essentially gaming the system. They would do a conversion in January. They would see how they performed throughout the year. If they went up, they left it. But if they went down, they would recharacterize it and then redo the conversion all over again to try to save some tax dollars. So what they did with the tax reform is they eliminated what are called recharacterizations. So when we do a conversion after 2017, that is irreversible. We want to make sure that we're very strategic in terms of the amount and recognizing what the tax impact is going to be as we do that conversion. The ability to convert from a traditional IRA to a Roth did say the same. However, we just cannot undo it. All right, the tax child credit. So what they did, this is what I like to call the Rubio tax credit. But what he did, he was one of the last senators to get on board with the tax reform, is he was demanding for tax credits, child tax credits. And this is one way that they've ultimately benefited households with getting rid of the exemptions, personal exemptions. But it's $2,000 per child if your income is below $400,000 and starts to phase out. If you make over $440,000, unfortunately, you don't get any level of credits. Now, the one thing that's important to mention is these are credits, not deductions. So credit is a below the line reduction of tax obligation, whereas a deduction is just reducing the taxable amount. So credit's meaningful. And so ultimately for households below 400 grand, married, single, 200, this is actually a good thing. One of the big things that also changed with the 2018 tax reform was they effectively, I don't want to say eliminated, but they dramatically reduced the impact of alternative minimum tax, AMT. And what happened was, you know, an AMT, for anybody who doesn't know, is a secondary tax calculation to make sure that people are paying at least a certain level of tax threshold. AMT was created in the mid-60s, 1960s, and what happened was they never indexed up those numbers. And so what used to be only impacting the top 1% of people, all of a sudden was now, because those numbers hadn't indexed up at all, was impacting a lot more Americans. In 2017, 5.2 million Americans paid AMT taxes. In 2018 and beyond, that number dropped down below 400,000 taxpayers had AMT calculations. And the reason for this is because they dramatically impacted the thresholds. At the same time, too, they've gotten rid of a lot of the itemized deductions. But what they did was in 2020, the AMT exemption starts off at, if you're single, $72,900, joint at $113,400. So for most people, it's not material, but it's nice to have AMT simplified. All right, 529 plans, some big change that happened here, and this has still been ongoing. But you can take $10,000 out now from a 529 to pay for elementary school, secondary school, or private religious schools. So great way to help, especially if you want your children or grandchildren to be going to private schooling. We can get some money into a 529, let it grow, and if it's being used for qualified education expenses, it's tax-free. It's a great strategy for grandparents who are wanting to help with grandkids' education. And ultimately, if they don't use it for elementary, secondary, or religious schools, they can use it for college or MBA programs. Phenomenal strategy to consider. Definitely something I recommend. You can contribute up to $15,000 per year, per husband, per wife. And with 529s, you actually have the ability to do a 5-year front load. So if you're feeling overly generous or very generous, you can actually put $150,000 into a 529 in 1 year and satisfy 5 years worth of donations into those. So you can really have a meaningful impact. And as I said, if it's used for qualified education expenses, it's tax-free. It's awesome. Annual gift tax exclusions, these did increase up. They have not indexed up since they did this, but you're able to give $15,000 per person, $30,000 per couple, without even having to file a gift tax form. So annually, you can give, if you're married, $30,000 a year with no questions asked. I was just using the same number for the 529s. That's where we ultimately get it from. I just had a question. What happens to the 529 balance if it's unused? So ultimately, with 529s, you can always be what's called a qualified beneficiary. So it's basically anybody within your lineage. Worst case, you can change it to, so if you establish them for your grandchildren, for example, you can always change to any one of the other grandchildren. The other thing that I also see is you can actually change it to yourself. So if you have ambitions or desires to go back and get a master's or a PhD, We even had a client who had $40,000 left in a 529 a couple years ago, and he used it all to go to a golf institution in Scottsdale for 6 months. That was something that was important to him. But worst case, you have to pay tax on the gain. So ordinary income on the gain if you don't end up using it. Most of the time, these things just get left in, and you can roll it into grandchildren, or if you originally established them for your kids, you can change the beneficiary to be your grandchildren, etc. But there's a lot of ways of doing it. Definitely want to be mindful of any tax hit, though, on any of the appreciation in those. All right, another big notable change was the estate tax exemption dramatically increased in 2018. So they went from, in 2017, the estate tax threshold was 5.49 million for a single, 10.98 million for married. They moved up to 11.2 million for an individual and 22.4 million for married, and that has indexed up. So for 2020, it's 11.58 million of federal estate tax exemption levels, and 23.16 million for married households. Now, one thing to comment on this, depending upon what state you live in, the state you live in might impose a state estate tax level. These are federal, and not all states are following suit with what's going on with the federal level. So just something to be very, very careful on, depending upon what state you move into. For example, Maryland, New York, Connecticut, New Jersey, a lot of those states are high state estate tax states. Washington State is another one. Just be mindful of it. I'm not saying don't move to those states, but just be mindful of it, especially as we're doing some planning work and knowing what potential tax implications could be. I had another quick question. Follow up on the 529s. Is it usable only at state public schools? Oh, no. 529s can be used for any accredited institution. There's several international institutions as well. So it's not just state or public schools. 529s have a lot of flexibility. And as I mentioned, with the tax reform, you can use $10,000 a year to pay for elementary school. Again, and typically that'd be private school or a charter school that would have a cost to it. Secondary school or a private or religious school. So ultimately, if, like, for example, you want to have your grandkids go to a religious elementary school, for example, you can use the 529 to help accumulate. And if it comes out for that purpose, it's tax-free. All right, I'm getting a little long and I apologize for that. So I wanted to wrap up and talk about strategies to consider now. So we talked about contributing to the Roth via the traditional IRA, especially while you're working. If you don't have traditional IRAs, consider the backdoor Roth contributions. They are fantastic. It's a great way of getting money growing tax-free. It starts that 5-year clock to get that money tax-free. Definitely want to recommend those. Once you've transitioned into retirement, we need to talk about some of the long-term planning. And the reason we talk about long-term planning is because we're really monitoring and looking at what your tax brackets are going to be for the projected rest of your lifetime. And obviously there's some assumptions that have to go into it, but if you're going to have some really low years of tax brackets, especially in the early years of retirement, let's look at using some strategies that are going to really optimize for the rest of your lives, and especially if you're in a position where you're transitioning wealth to your heirs. Talk about that more in a second. Utilizing net unrealized appreciation from 401ks once you've retired, that's another strategy we should talk about. I mentioned selling stock at 0% long-term capital gains rates. I also mentioned donor advised funds. That's not exclusive to being retired. You can do that while you're still actively working. Definitely a great strategy if you're charitably inclined and have stocks that have gains in them. And then last one is for business owners, know the pass-through entity rules. Now, when we talk about Roth conversion strategies, I want to spend a tremendous amount of time here, but we should look at what is your average tax rate now versus what your marginal tax rate is. And there is a clear delineation of when it makes sense to do Roth conversions versus pre-tax contributions into a 401k account. And you can see it when your average tax rate is higher than your marginal tax rate, then it absolutely makes sense to get money into a Roth. But on the flip side, if you're going to be paying less in taxes, meaning your effective tax rate, which is most of America, is your effective tax rate is lower than your marginal, then we shouldn't necessarily look at Roth conversions. And that's where every household is going to be a little bit different. But ultimately what we're illustrating here is this is just an example for someone that we've done some planning work for, where they retired in 2020 and all of a sudden they went into a period of time with low brackets. But then all of a sudden, because of the required minimum distributions they got jacked right back up to the 33 and 35% tax brackets. My point is especially if you have the ability to control your taxable income, let's look at the years that you're going to be in lower brackets, and let's utilize that as some planning time to be able to reduce lifetime tax implications. So here's just some numbers to kind of quantify this. And what we're looking at is, in the base case, if they do nothing, they're going to go into the 12% and 10% brackets in the first couple of years. One of the things that we might want to model or look at and consider is do some Roth conversions in these low bracket years. So what we're doing is we're making the decision to pay tax now in order to reduce lifetime or long-term tax burden. And ultimately, it's going to mean that it's going to reduce the amount of required minimum distributions that you're going to have to pay. And it's also going to increase the amount of money that's going to transition to your kids tax-free. Whereas if we don't do them, it's going to be an IRA account, so they're going to pay more in ordinary income. But this scenario really, it's not fully optimized in that we still have a couple years in here where we've got 35% bracket exposure. But in the base case, if we do nothing, a couple years into retirement, they jump right into the 32% tax bracket. And then that transitions over to the 35. Whereas with doing a little bit of planning work, we're able to keep them in the 24% bracket for longer. And that's ultimately why Roth conversions make sense. And I will say, since 2020 is a year where the CARES Act has eliminated the need to do RMDs, this is a great strategy year to consider doing Roth conversions where you otherwise would have had taxable income. If you've got other assets, other buckets to live off of to keep your taxable income low, we're kind of getting a redo year here to consider doing some Roth conversions. And this is a great strategy to look at. I also get asked the question a lot about doing some conversions within the ExxonMobil 401k. I wanted to include a couple slides on this. I've hit it before. But really what we're talking about is if you've got tax paid money, after tax money in the 401k, you do have the ability to convert that over. Just be careful. One of the things that I think makes a lot of sense, and we need to look at it comprehensively in conjunction with some of the net unrealized appreciation strategies as well. But if you've got tax paid money in the 401k, and I'm specifically talking about what's listed at pre-87, post-86, not the after-tax accounts, but if you've got this bucket here, maybe consider withdrawing part of it, doing an in-service withdrawal while you're still actively working. Take the withdrawal, move it over to a Roth IRA. So take this, in this example, it was $274,000, and roll it to a Roth IRA. Now, in order to do this without any tax, you also need to take out the appreciation as well. So ultimately, in this example, you'd be taking out $562 grand. So it'd be the gain has to also come out and go to a traditional IRA. But the benefit of this is we're getting into in this environment where we're in a low tax bracket, in a still working, and we're trying to get money over into a Roth IRA. Get the money growing tax-free, because remember, while the money's still sitting in the savings plan, it's growing tax-deferred. So it's accumulating this after tax. And all of the gain, you'll still have to pay ordinary income to take out. Whereas if you take the money out while you're still working, get it rolled into a Roth, now the growth is going to be tax-free, again, assuming you're 59 and a half, and that money's been over there for over 5 years. Question here, how is a SEP IRA different than a 401k? It's still a retirement plan. SEP IRA is a retirement plan that's established for self-employed individuals. Very different in terms of the rules and contribution limits that you can do. For accounting purposes, they get treated very similar to traditional IRAs, but ultimately the contribution thresholds are significantly higher based upon the income or profitability that the business is having. All right, real quick. Now, I am proposing people do withdrawals from the savings plan of the tax paid. This is actually very different than doing conversions of tax paid within the strategy. And the reason that it's different is that because if you do conversions within the savings plan, you actually will still have to pay tax on that attributed gain. So there are two categories of individuals within the savings plan, and there are some slightly different nuances. So employees that are under 59 and a half, they can convert a portion or all of the balance from their after-tax and general accounts to a Roth conversion account. However, the before-tax account cannot be converted. If you're still working and you're over 59 and a half, you can convert a portion or all of the balance of all non-Roth accounts to the Roth account if that's something you want to do. I've never seen it happen, but you can do it. Now, the basis of your stock ultimately does not matter. And one of the questions we get a lot is, should I convert ExxonMobil stock in kind? Well, unfortunately, you don't have the ability to do that. In order to convert ExxonMobil stock within the savings plan, it actually gets liquidated. And it takes them 5 to 7 days to do the conversion, and then they buy it back. So if we're really trying to be strategic in terms of timing of where the stock price is at, very difficult to do. As we've seen over the last several weeks, we're seeing 2 to 3 point movements every single day, and ultimately you can get hurt just by seeing the differential in the stock price. Now, if you want to convert over, and I'm just going to use this quick example here, but if you want to convert over your after-tax account, let's just say 60% of its after-tax contributions and 40% of its untaxed gain. So let's say you convert the entire after-tax account. Well, ultimately what's going to happen is that you'll move the entire amount out, but 40% of it's going to become taxable income. And the same thing goes if you prorate it. So if you convert 50% of your after-tax account to the Roth, 40% of the 50% will be taxable. So very important. Talk to an advisor, talk to us. We're more than happy to help with what makes sense in your situation, but definitely something to look at while you're working. All right, one of the other strategies I wanted to talk about is outside of the 401k plan, and this is specifically talking about tax loss harvesting. So it's talking about non-qualified accounts, after-tax brokerage accounts. But consider selling securities that you are showing losses in now. So a capital gain or loss is unrealized if you own an asset and you've not sold it, while a realized gain or loss is when you actually buy or sell the transaction. So you're realizing a loss when you sell it. Now, realized capital gains generates tax liability, and a capital loss can be used to offset tax liability of other gains. So long-term capital gains gets offset with long-term capital losses. Short-term capital gains gets offset with short-term capital losses. And then ultimately, if you have long-term losses, they also can offset short-term gains. So what I'm proposing is, if you've got stocks that are down now, might be, for example, ExxonMobil stock that's down and you now have a unrealized loss, maybe let's look at this as an opportunity as best we possibly can. I know it's kind of sadistic to think that way, but with the stock being down and if you now have a loss, and we don't believe ultimately that position is going to come back faster than some other areas of the market, then maybe we go ahead, harvest the loss, use those losses to be able to offset future gains that we have, and then reinvest the proceeds into something that we think is going to do better quicker. And so that's a strategy to consider. Now, there are some considerations we want to be mindful of. The first is we want to be very mindful of what are called wash sale rules. So a wash sale is designed to discourage people from selling securities at a loss simply to claim the tax benefit and then immediately buying back into the same security or what's defined as a substantially identical security. So it might be that you sell out of a Vanguard at 500 S&P 500 position and you buy into a Spider S&P 500 position. That'd be deemed as substantially identical. Just want to be careful. You could sell out of a Vanguard S&P 500 position and buy into the Dow if that's what you wanted. That's different. But just be very careful of what you're reinvesting in. Now, for example, you could sell Exxon and buy Apple. I mean, they're not identical at all. It's a totally different transaction, and you could realize the loss and then get into something else, as an example. Now, if you've been affected by a wash sale rule, your loss gets disallowed, and then they add in the differential back to the cost basis. So ultimately, let's say you sold Exxon to realize the loss, and then you bought it back within 31 days. Well, you're going to end up owning it and getting the same original basis, and then just tack on whatever the applicable loss portion was onto the basis. All right. Now, one thing that benefits with these tax loss carry forward rules is that the tax loss carry forwards can actually be carried forward indefinitely. There's no clock on them. And you have the ability to actually, let's say in a year, you don't have any gains to use to offset some of the losses that you harvested. Well, you have the ability to take $3,000 of that loss to offset against taxable income, ordinary income. So let's just say, again, 2020, you never have any realized gains. I hope that's not the case, but let's say you don't. Well, let's say you harvested $10,000 of losses. Well, you get to use $3,000 of that 10, so you'll carry forward 7,000 into 2021. And let's say, for example, in 2021, you have no more losses, then you get to use another 3,000. And then going into 2022, you get to carry forward another 4,000. So you get to use these until they're completely exhausted. So tax loss harvesting is another great strategy to consider as we talked about some different optimization work. All right, I spent a lot of time today. It's been about an hour. I apologize for going so long. I did want to offer, Bogart Wealth does absolutely no cost, absolutely no obligation financial planning work, and will help with some of these different tax strategies, whether it's Roth conversion analysis or net unrealized appreciation analysis. We're delighted to be a resource for you. We don't work with only ExxonMobil households. I know we get that question a lot. But if you have friends who are in the middle of a transition, job loss, or they're being furloughed and they need help, we're delighted to be a resource for them. We've been doing a tremendous amount of planning and consulting work recently just because of it. I did have a couple other questions. While I'm doing that, I wanted to include the slide. This is my team. This is, feel free to reach out to them. I'm gonna answer a couple of these other questions that have come in. Would tax loss harvesting apply to after-tax monies taken out of the ExxonMobil 401k and then performing a Roth conversion on it? No, so tax loss harvesting is only talking about brokerage accounts, non-qualified accounts. So it would be an account that your checking account's technically a non-qualified account. Now, obviously, you're not going to have gains or losses there, but I wanted to use that as an example. A brokerage account might be if you're getting restricted stock, computer share accounts. Those are all non-qualified accounts, after-tax assets. If you have established a relationship with an advisor or set up a Schwab or Fidelity account, and it's a brokerage account, those all apply. Definitely something that you can do just with non-qualified accounts. So if you have money in a Roth or a traditional IRA or even in the savings plan, we don't care about the tax implications in the plans. All we care about is what the performance of is of those vehicles, and then we pay tax when we take the money out of a traditional IRA or 401k. Another question I had is if you're going to have an expensive tax year, let's say I'm retiring this year with a non-qualified pension benefit, how do I reduce taxes in this year? Now, one thing I'd say with that, for those that have non-qualified pension programs, I've talked about it a little bit today. The challenge is if you've worked an entire year and then all of a sudden have it, you're most likely going to be in a higher bracket, or some of the money that you've earned from working is going to push your bracket up a little bit higher. In order to reduce taxes in a year where you're going to be in a very high tax bracket, there's really only two strategies that make sense. Charitable gifting. So if you're going to do it and you're charitably inclined at all, definitely consider doing it if you're going to have that event this year. Or if it makes sense, maybe consider pushing until the first quarter of 2021, so you have less earned income within that year. Typically, a lot of people who have supplemental pension programs or additional payments plans, they usually go in the first quarter. Now, obviously, I'm not saying that to disincentivize retirement. We need to watch interest rates and what happens there. But if we can get into a year where we have less tax exposure, that does make a lot of sense. And then the last strategy that for those that are going to have an expensive tax year, if you're ever going to consider starting a business, that's the year. The year that's an expensive tax year is the year to do it. If you've got a lot of startup costs, those are some of the best ways to be able to offset some of the tax hit. I mean, ultimately, it's still spending money, but if you're going to start a business, that's the year to do it, because that helps with managing some of those tax assumptions as well. All right, so I've exhausted my time today. I thank you all for your patience in continuing to join. Still see a very significant number of people here, so obviously kept your attention. But feel free, reach out to any one of us. Here's our contact information. And as I mentioned, if you have friends who need help, we're delighted to do a plan. Absolutely no cost, absolutely no obligation. We are recording this. If you'd like to get a copy, feel free, ask Mindy or any one of our team members, and we'll get a copy over to you. But thank you very much. Stay healthy, stay well, and we're here to be a resource for you. Thank you.